Hello and welcome to Business Incorporated. I'm Chimezie Obi Iwagu. On the show today, JP Morgan cut South Africa's local bond exposure, citing deteriorating fiscal outlook. Zimbabwe starts rolling power cuts, and mining companies hit the most. Plus, European Union tips Malawi on future budgetary support. Let's get the show started now with the markets, and market sentiments here in Africa were mostly negative at intraday. The EGX 30 in Egypt was the hardest hit, down 1.89%, while the Nigeria's NSE index was down 0.04%. Only the JSE index was up at intraday, gaining 0.32%. Kenya closed negative on Friday. And major Gulf markets opened Monday's trading session negative as all indices were negative at intraday. Markets in the UAE got a haircut and were down 3.32% and 3.39% each. Saudi's index was down 2.57%, while Qatar was down 1.89% at intraday. And markets in Europe traded lower in the morning, with investors continuing to monitor trade developments between the U.S. and China. Ashutosh Pandey joins us now for details from the Frankfurt Stock Exchange. Hello, Ashutosh. Good afternoon. Good to see you again this week. Our trade tensions between the U.S. and China have been escalating since President Trump announced the latest tariff hike last Sunday. That must surely be unnerving the markets, even in Europe. Well, we seem to be having issues with audio there, speaking to Ashutosh, but we'll get back to him as soon as we're able to rectify what the issues are. While the uncertainty on the U.S.-China trade front continues to rattle the market, well, let's get a sense of what is on tap in London with my colleague at our London studios, Juliana Olayinka. Hello, Juliana. Good afternoon. Thank you for joining us on the show.
Good afternoon. Thank you for joining me from a sunny London. And it's sunny and cold. Of course, it's London, so you can expect that. I must say the FTSE 100, it did open up 6 points earlier today, but it's now slightly down. We can see we have a small graphic here to show the FTSE all-share markets. The FTSE 100 down 0.12%. The FTSE 250 also down 0.58%. It did have a surprise jump, and surprise, oil was a major factor at driving the trade up earlier this morning. Saudi Arabia said that 2 of its oil tankers came under attack off the coast of the UAE yesterday, and shortly after, the UAE said 4 of its vessels had been sabotaged amid rising tensions in the Gulf. That was quite good for Britain. These tensions slightly lifted the shares of UK oil majors BP and Shell. Shares in both companies are up about 1.4% so far today. One of the major drivers in the fluctuating market is the mobile phone network Vodafone. It was the worst FTSE performer over the weekend and this morning, weighing heavy on the market. The mobile phone network has dropped 4% following a report that the company could be about to cut its dividends. And lots going on.
So what corporate news is making headlines in the UK market today?
I would say in other corporate news, of course, as we've been talking about, and we were talking about it last week, the US-China trade talks do remain deadlocked. In equity markets, British gas owner Centrica was the top riser as it maintained its full-year guidance on cash flow and net debt, but said a challenging environment due to falling gas prices, tariff caps, warmer weather, and nuclear outages has forced it to conduct a strategic review of its portfolio. I'm sure everybody's heard of Marks and Spencer's, and they were also on the front foot today after an upgrade to buy it at Citi. Just one quote and it sent shares rising. Citi said that M&S is a business which is making itself more relevant for the next decade. So that was a good quote for M&S there. And on the downside, shares in Metro Bank has slumped as the challenger said plans to raise £350 million of equity capital were well advanced after it was forced to reassure customers that their money was safe. So not good for them.
All right, Juliana, it's a new week. So what's on tap for the rest of the week? What should we be expecting?
well, gosh, you know, Trump is in the news again. And this time, it's the U.S. relationship with the EU. The U.S. president's trade wars are not over just yet. Before the end of this week, we're expecting Washington to impose levies on EU car imports. The U.S. and the EU basically reached a political accord last year to work towards a limited trade agreement, which would put on hold the threat of tariffs on EU cars. Now, the European Union, amidst all what's going on with China, is now finalizing a list of American goods to target in retaliation, just in case US President Donald Trump does impose levies on car imports. And just to give this some perspective, a 25% US levy on foreign cars would add 10,000 euros to the sticker price of European vehicles, something I definitely couldn't afford.
Neither can I afford that. Anyway, thank you very much, Juliana. We hope to keep a tab on those developments, and perhaps we look into it more in the course of the week. Well, we cross over back now to Frankfurt Stock Exchange, where my colleague Ashutosh Pandey is ready to talk to us. Hello, Ashutosh. Thank you for coming through to us. Good afternoon.
Hi, Chimi. It's good to be on your Channels TV after a good weekend.
Right. So trade tensions between the U.S. and China have been escalating since President Trump announced the latest tariff hike last Sunday. That must surely be unnerving the markets, even in Europe.
Well, yes, exactly. I mean, it has been weighing on sentiments all day today. And right behind me, if you can see, the DAX has further nosedived. And that's because there's news just coming in that China has retaliated with new tariffs of between 5 to 25% on 60 billion worth of US imports. And now this move is going to impact 50,000 US products and will kick in on June 1st. So clearly the investors here are worried about a looming trade war. But in the morning, the sentiment was a little down, but there was hope that the two countries will eventually reach a deal, and the fact that it wouldn't escalate any further. That's because they feel that last time around, when there were these fears of a trade war, the equity markets across the world had seen a major rout, and this time around they don't want the same to happen, and that's the reason why they feel that both China and the US would eventually sign a deal. And also the fact that they feel that there is this grace period on the latest hikes that the US announced, because they would only be applied to those goods which have left, which are going to leave China after Friday when it came into effect. So which basically means that the goods which left China before Friday and would reach the US before the 1st of June, they would not be subject to the increased tariff. And so they see this as a window of opportunity for the negotiators to still try and etch out a deal. But with this latest response from China, it seems that the investors are a lot more worried now.
Now, China has threatened retaliation. What options are there for Beijing?
Well, so this was one of the they've retaliated in the form of new tariffs. But they have limited scope when it comes to retaliation vis-a-vis if they have to go and apply something in terms of tariffs. So they have a limited scope there, because they've already imposed tariffs on 91% of the goods that they import from the US. But what are the other options? The other options are clearly they can let their yuan depreciate versus versus dollar. The central bank in China has maintained a tight grip on yuan so far, and they've kept it stable vis-a-vis dollars because they say as a goodwill gesture, because the talks were on. But now they may just let it weaken a bit further, and the yuan is already down today itself, and it's almost at the lowest since January. So that would clearly soften the impact of these latest tariffs by the US. And the other option is that which is being already reported, that China is delaying some customs for US shipments. They are trying to delay their approvals for them. They are also increasing regulatory pressure on some of these companies. There's more regulatory scrutiny on US companies in China. So these are some of the measures that Chinese are already taking.
Ashutosh, it's not only China that is paying a price of the tariff hikes. US consumers are suffering too, isn't it?
Absolutely, and there is no doubt about it that they are suffering. And there's a Goldman Sachs report that just says that, yes, they have, in fact, faced the brunt of the tariffs so far. And that is even when most of the sanctioned goods were those components that were used by manufacturers. They were not necessarily consumer goods. And now when Trump is threatening to expand the tariffs to the remaining goods that are not yet taxed, it's going to hurt the consumers even more, because they are like, even the latest round, 10% of the goods when they were being taxed at 10%, that was still okay. Businesses could take the brunt of it and not pass it on to consumers. But 25% is going to be too difficult for them to manage. And that's the reason why consumers can expect the prices to go up. And think of it, the kind of market that, the kind of supplies that come from China, it's huge. And clearly that impact is going to be felt by the consumers at the end of the day.
All right, thank you for your time, Ashutosh. Let's continue to follow those developments there. The week has just started. Enjoy the rest of the day. And in Asia, mainland Chinese shares declined today amid uncertainty on the U.S.-China trade front after tariffs on Chinese goods were raised last Friday. The Shanghai Composite tumbled 1.21% to close at 2,903.71, and the Shenzhen Composite slipped 1.076% to close at 1,551 points. Other major Asian markets also fell. The Nikkei 225 in Japan declined 0.72%. In South Korea, the Kospi fell 1.38%, while Australia's ASX 200 shared 0.21%. Markets in Hong Kong were closed on Monday for a holiday. And in the U.S., stock futures pointed to sharp losses today as investors keep fretting over the state of U.S.-China trade relations. As 6:49 a.m. Eastern Time, Dow Jones Industrial Average Futures indicated a drop of about 280 points at the open. S&P 500 futures pointed to a loss of 1.1%, while Nasdaq 100 futures indicated a drop of 1.5%. Trade bellwethers Caterpillar and Boeing fell more than 1.5% each, while Apple dropped more than 2%. And away from the equities and back here on the African continent, Zimbabwe has started rolling power cuts lasting up to 8 hours that will also hit mines after reduced output at both the largest hydro plant and aging coal-fired generators. The power cuts will add to mounting public anger against President Emmerson Mnangagwa's government as Zimbabweans grapple with an economic crisis that has seen shortages of US dollars, fuel, food, and medicine, as well as soaring inflation that is eroding earnings and savings. The Zimbabwe Electricity Transmission and Distribution Company said power cuts, known locally as load shedding, would start on Monday and will last up to 8 hours during morning and evening peak periods. Mining accounts for more than 3/4 of Zimbabwe's export earnings, and any power cuts in the sector will affect production and exports. In the past, some of the big mines, including platinum and gold producers, have resorted to directly importing electricity from neighboring countries like Mozambique and South Africa. Zimbabwe last experienced its worst power shortages in 2016 following a devastating drought. The European Union has indicated that its budgetary support to Malawi may not be sustainable in future owing to the country's rapid population growth. The EU ambassador to Malawi, Sandra Persson, says that the country's population will grow at unprecedented and unsustainable levels within the next 20 years, reaching 30 million people. Ms. Persson explains that the EU may not be able to match the growth within the same time span in terms of budgetary commitments, as the Union cannot keep track with the country's needs. However, she advises the government to invest more in addressing the adverse effects of climate change, as deforestation and precarious living conditions in rural areas intensify the negative impacts of climate change in the country. And when we come back, we cross over to South Africa as we look at the expectations from the Ramaphosa's government. Stay with us.